Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. It was a good summer for the three major indices. The NASDAQ and the S&P 500 posted gains of more than 8% from the beginning of June until Labor Day. The Dow was up also nearly 6%. But this week marks the unofficial beginning of fall with Labor Day now behind us. That also means we're heading into a period of sometimes some very big swings in the stock market. And here to give their thoughts on where we have been and where we might be headed is my panel of financial advisors and analysts. Let me introduce them to you now. With a prime seat at the table is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also seated at the table is Frank Bracetti. Frank is the managing director of HF Management Company, which is part of an alternative asset group and partnership. Now, Frank's background includes 50 years in the investing field, and he also helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and the founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on Bloomberg, on CNBC, and also on Fox Business. And in the chair and ready to go is Michael Godwin, with Fregasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fregasso Financial Advisors. And again this year, we should note that Fregasso Advisors is listed among the Barron's top national 100 independent advisors. I want to thank all of you once again for joining me for Around the Table with Stacy Smith. And we have a topic to discuss today. Now, I'm not a mathematician, but by my calculations, which could be wrong, I don't think they are, but they could be, over the past 50 years, 55% of the time, the S&P 500 has lost an average of 3% just in the month of September. But by the time the end of the year rolls around, 70% of the time, the S&P 500 has gained an average of nearly 7% from September through December. So with wage increases, the Fed threatening more rate hikes, and mortgage rates at levels not seen since July of 2001, I'm throwing out this topic. As we head into the last 4 months of the year, your thoughts on the economy and the stock market? Carrie, I'll let you answer first.
Well, it's a complicated question, as you can imagine, but we are heading into one of the most volatile timeframes of the year. You know, I tend to say that over the summer, people are away, they're not really focused. And when we get back to business, we tend to get more volatility in the market. I think that will be especially true this year for a number of reasons, mainly because this debate about inflation and interest rates and what the Fed is going to do will have impact, but also the consumer. We really need to stay focused on the consumer. There's a lot happening. The student loan repayment is now started again. Consumers are tapped out on their debt. We're starting to see some cracks with consumer credit delinquencies. And if that consumer slows down, I think companies are going to feel the impact of it, which will cause some added volatility. In a situation like this, diversification matters. You know, when you really can't and really know that we're going to have a volatile period, it's really best to make sure that you're well diversified and not carrying too much risk based on your risk tolerance.
I think Carrie's right there. I mean, that's the number one thing we're paying attention to right now, Stacy, is the consumer and really the unemployment rate. Okay, so the unemployment rate at 3.5%, I've been saying for a while, is probably the best thing going for the economy and for the markets because the unemployment rate is so low. Wages have increased a bit. You know, have they kept pace with inflation? That might be debatable, but consumers still feel flush with cash right now, which is a good thing. But make no mistake about it, with the Fed raising rates from 0 to well over 5% in such a short amount of time, they are actively trying to slow down the economy, which, you know, slows down inflation. So when you slow down the economy, that's going to put pressure on the unemployment rate at some point. And that's really what I'm looking at from an economic standpoint is at what point does the unemployment rate or the jobless claims start to tick up? Because that, to me, would signal that the markets might be in for a bit of a bumpy ride in the not so distant future.
Like, if I can ask this question and anybody can jump in, given what you just said, Michael, aren't the unemployment figures that we have they're looking back. So, I mean, by the time you get those numbers, things have already started to roll that way. Or am I wrong?
No, you're right. You always see revisions to the unemployment numbers as well. That's why jobless claims is probably a better indicator to look at as you start to see jobless claims which come out more frequently. And these are like new jobless claims. So people who are now filing for unemployment, that's probably a better indicator to look at than just the unemployment rate. So yeah, the unemployment rate is a little bit backdated there. There's always revisions to it. And there's always moving parts to it too, Stacy. The unemployment rate just jumped from 3.5% to 3.8%. But that's because the participation rate has gone up recently, which is that's also a good thing. More people are actually entering back into the labor market, maybe because their excess cash from the COVID stimulus is starting to dissipate and go away. So more people are entering the labor market. So you got to kind of take these into context for what there are. But long story short, we look at the jobless claims, or the new jobless claims, as a pretty good indicator of where unemployment rate might be headed going forward.
Just to add to that, or maybe take away from it. Months ago, Stacy, you asked me what I thought the biggest problem was for the U.S. economy. My answer was, we don't have enough people. That is still the case. We had COVID cause people to leave the workforce. And now, as the recent number shows, they may be coming back in. And that is a good thing, as Mike says. I believe that the lack of people is not going away. I don't believe we're going to have an unemployment problem of any severity in the foreseeable future. And I believe interest rates are pretty much done going up. There might be a tick or two, which is more optics than meaningful. And I think the corporate earnings are starting to rise. And I think that as we go forward in this market, stocks are going to be valued higher for yet another reason. The supply of stocks is shrinking. So with shrinking supply and increased demand with the money that's still there, I don't really see anything other than opportunity when the market dips, because the wild card is always emotion. And emotion will cause the market to go up unnecessarily and unreasonably. And as someone said about 25 years ago, irrationally go down. Okay. And that being the case, when it irrationally goes down, I would just trot in with money and
That was
buy
Mr.
your
Green.
shopping list, if you will.
That was Mr. Greenspan with irrational exuberance, I believe was the
I
phrase
think
he used.
that's what it was.
Yeah. Kim, your thoughts?
Eventually he was right, but he was just 3 or 4 years early.
Yeah, Kim.
So I think this is really fascinating that we all have a different view on what's important to markets. And to me, this is an exercise in mathematical modeling. Of course, everything goes back to math and tech for me. Sorry, when you start there, you can't ever get out of that thinking. But I think it's really interesting that each person is looking at this behemoth called the US economy and deciding, well, this is the consumer's important. I could rattle off through, and I think they all are, but we're all playing a slightly different game with the market. And I don't ever want to make the comment that could be taken out of context. Money that we are entrusted to is not a game, but everybody has a different focus for a different time horizon and a different risk tolerance that they're trying to address. So that's what I'm trying to say. So each one of the four of us on this show in particular has a slightly different view. My view is this. I just had to call that out. My view is I like to look at the whole thing, the whole planet Earth, the whole economy of Earth. And because the US is still the reserve currency, that means many other countries use our dollar for many different things. But we hold this really great place where we are the currency that people look at in times of trouble. Europe is sort of a hot mess right now. They keep raising rates. It's not helping inflation. They have a lot of factors that we could go into, and maybe we will in the next half hour, but there are no short-term solutions to turn Europe around. An engine of growth used to be China, that their people came up so quickly the last 40 years from abject poverty to relative affluence. And they have a lot of billionaires, but we're talking about, on the whole, people's lives in China are much better today than they were 40 or 50 years ago. But it seems as if that miracle is slowing, and it could be dangerous, as that's an, totalitarian, dictatorship, whatever you want to call it, that the person in charge wants to stay in charge. So they can get irrational, even around, or especially around, economic things. And all of these things make the US look like a stronger place than if we look at any of the one or two kind of things that we're looking at to see what's going to happen in the next 4 months. So again, I play a much longer game, 3 to 5 years. If you give, that's my kind of focus on things. And looking at China and Europe, I think the US is going to remain incredibly strong in the world, and our markets thus will rise.
Okay, we have to take a break. We're way over our time limit. We'll be back in just a moment.